Scope 6 want to present about the building understanding, which is the role of the conceptual framework in financial reporting. There are 4 objectives related to the topic. First of all, this topic can be able to provide information to users. What I mean by this, the information is delivered, accurate and reliable to the important people who are in this field, which could include employees, management, investors, and so on. By this, it ensures transparency and builds trust in an organization. The second objective is to monitor management stewardship. This is because they want to see how management handle resources, ensuring they are used effectively and responsibly. This goal is to ensure accountability, credibility, and so on. After that, the third objective is to facilitate economic decision making. This can be able to help people in this field in making informed financial and economic decisions based on the data and analysis given. This can be improve financial stability. This means that while decision making in economic helps in maintaining a balanced budget. Last but not least, the last objective of this title is to assess financial performance and position. This means that they want to focus on how to make their organization financial health, analyzing profitability, liquidity, have the highest quality in the world.
Now we have 4 qualitative characteristics. The first one is relevance, the second one is comparability, the third one is understandability, and the last one is reliability. The first one is relevance. Information is relevant if it helps users make decisions. It should have predictive value, help forecast the future, or confirmatory value, help assess past decision. The second one is comparability. Users should be able to compare financial information between different companies and across time periods for the same company. This helps users identify similarities and differences between the company. The third one is understandability. Information should be clear and easy for users with reasonable financial knowledge to understand. Example, avoid using overly technical terms without explanation. And the last one is reliability. Information must be trustworthy and accurate, reflect with what it claims to represent. It should be complete, natural, no bias, and free from significant errors.
Next, I will explain about financial statement. So what is financial statement? Financial statement are reports compiled by the businesses that details the company financial activities and health. So financial statements are often audited by government agencies and accountants to ensure accuracy for tax, financing, or investing purpose. So financial statements are used by investor market analysis. They credited to evaluate a company's financial health and earnings potential. So the 3 major financial statement reports are balance sheet, income statement, and statement of cash flow. So what is the component of financial statement? Which is we have 5 components of financial statement. First is statement of profit and loss, which is statement of comprehensive income. Next, statement of financial position, statement of change in equity, statement in cash flow, and notes to the account.
Measurement in financial accounting refers to the process of assigning monetary values to the components of financial statements, such as assets, liabilities, equity, income, and expenses. This process is fundamental because it ensures that financial elements are consistently and accurately reported, providing users with relevant and reliable information for decision making. The choice of measurement basis for each element depends on several factors, including relevance, faithful, and cost constraints. The conceptual framework for financial reporting identifies two main measurement bases. The first is historical cost. This is the original amount paid to acquire an asset or liability, and it remains unchanged over time. Historical cost is considered a reliable measurement because it is verifiable and based on actual transactions. The second one is current value. This encompasses different approaches that aim to reflect the current worth of assets and liabilities. Each of these measurement bases has its advantages and limitations, and their use depends on the nature of the item being measured and the specific reporting requirements. The goal is to provide a balance between providing relevant information to users and ensuring that the information is faithfully represented while also considering the cost of gathering that information.
So, what is recognition? Recognition is the process of capturing for inclusion in the statement of financial position or the statements of financial performance such as profit or loss, comprehensive income, and cash flows, an item that meets the definition of an asset, a liability, equity, income, or expenses. It is the process of incorporating in the balance sheet or income statement an item that meets the definition of an element. Will satisfies the following criteria for recognition. First, any future economic benefit associated with the item will probably flow to or from the entity. Second, items' cost or value can be measured with reliability. Recognition involves depicting the item in one of those statements, either alone or in aggregation with other items in words and by a monetary amount, and including that amount in one or more totals in that statement. The amount at which an asset, a liability, or equity is recognized in the statement of financial position is referred to as its carrying amount or carrying values, while asset, liability, and equity are recognized in the statement of financial position. Income and expenses are recognized in the statements of financial performance, which is the statements of profit or loss and statement of cash flows. To conclude it, recognition is basically to classify the types of account for each item in the statements that we make.
So for the conclusion, the conceptual framework in financial reporting provides guidelines for preparing consistent and useful financial statements and ensure reliable and transparent financial reporting aligned with users' needs and aiming to meet the needs of investors, leaders, and creditors. It highlights the importance of decision-useful information while acknowledging the inherent limitation of financial reports. The focus on future cash flow and the stewardship of management ensure that financial reporting serves as a reliable basis for informed economic decision.